All right. Well, welcome everyone. We have Brett Synicky, colleague from the West Coast. So thank you very much. And he's going to talk to us today about what we want to do is add value to what we're doing on the meetings, not just to see what's going on in the real estate side, but there's more to it than selling and buying, I guess. And thought we bring Brett, who can give us some information about solo 401ks and the checkbook IRAs, and tell us exactly what works for the investors and realtors in the market.
All right.
So Brett, you'll give it up to you. Take it away.
All right. Thank you, Rogelio. Really appreciate it. Nice to meet all of you. Um, so yeah, we're going to talk about self-directed IRA, solo 401k. I am going to share my screen. So just make sure that you guys can see it before I go too far down this journey. And you're going to want to pay attention for a couple of reasons. Let me know, Rogelio, that you can see that. All right. Thank you very much.
We can see it.
When I look left, it's because I have another monitor. I'm not looking at birds out my window, just so you know. You're going to want to pay attention as a real estate agent primarily for two reasons. Two reasons primarily. That doesn't make sense, right? But anyway, for two reasons. One, not only as an independent contractor, you're self-employed, right? You qualify for a solo 401k, so pay attention from that perspective. I'm not here to sell you directly on this. Obviously, I'm interested in having a call with you if you want more information, but I really want to focus in on how they work. And as a real estate agent, if you introduce these products, either the self-directed IRA or the solo 401k to your clients, and you can actually get more commission checks, because if they buy real estate within their retirement account and you represent that transaction, well, there you go. It's another payday for you. And so this can come in really handy for you, not just to have another tool in your tool belt and look smart when you're talking to your clients, but also realistically, hey, we just closed on this house, or maybe a check-in 3 months later. Hey, are you all settled in? How's everything going? A touch point. And then also, not only can you ask for referrals during that call, but, and by the way, I've had my real estate license for about 10 years. So I'm talking from a point of personal experience, but you can also say to them, hey, do you own rental properties? And they're going to say yes, no, maybe so, whatever. Or sometimes what they say is, I don't, because I don't have any money to do that. Well, guess what? Did you know that you can do it inside your retirement account? And 9 out of 10 people are going to say, I did not know that. How does that work? And maybe you know enough to be dangerous, but I really want to arm you with the tools necessary to just be able to say, roughly, here's how it works, high level, but I know somebody that you should talk to. And we can help people in all 50 states. Okay. So I am going to focus on the solo 401k today. Primarily, I'll talk about the checkbook IRA, but the solo 401k I'm going to talk about because you as a real estate agent qualify for it. And the checkbook IRA and the 401k work virtually identically as far as what you can invest in and that sort of thing. So I'm going to talk mostly about the solo 401k for that reason. Before I do, so that's me. I'm not going to spend a lot of time here, but Sense Financial is not a fiduciary. We do not provide legal, tax, investment, accounting, or other professional advice. If you need such advice, please seek out a competent professional in that area. My contact info is there. You're more than welcome to take that down, screenshot all of this. I don't care, whatever. By the way, I will give some time. I would love to have some engagement. So if you have questions, don't hesitate to put them in the chat. If Rogelio knows an answer, he can answer it along the way. If not, I'll definitely give time. We'll go through those questions at the end. I'm happy to do some Q&A. In fact, I welcome it. All right. So why us, first of all? Well, these are not real clients, by the way, but we have about 3,500 clients. We've helped set up well over 4,000 accounts for. And the reason I have this kind of diverse crowd on here is because not only can we help people in all 50 states, but I wanted to demonstrate, we do have a lot of clients, but also our number one source of business is referrals from our clients, right? Which is realtors. We're always striving to get more referrals from our clients. Well, at Sense Financial, we have, I think, done that at a very high level because we do offer really good service. And so one of the things that we say that we offer, and I encourage you to kind of rip some of this off for your real estate business if you'd like, but we offer unlimited client support. We want our clients to reach out to us for any reason whatsoever. Okay. And I'm not necessarily talking about something just related to IRA 401k, although 99.9% of the time, that's what they're going to be reaching out for. But we want to be kind of a professional advisor for them. Now, we are not licensed to give financial advice, don't misunderstand me, but we still want them to feel comfortable coming to us and asking us questions. And the way we're going to answer those questions is, hey, if I were in your shoes, here's what I would do. But consult your CPA, consult your tax attorney, whatever, right? Tax advisor. Okay, we have 5-star reviews all over the place. You can check that out. Our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. You work hard for your money. We want to come alongside you and work hard for you as well in this realm or for your clients and truly help you or your clients unlock their existing retirement funds, protect them through true diversification. Here's what I mean by that. You have conventional financing, which is that train that has to stay on the track, versus self-directed, which is virtually like the Wild West. You can pretty much invest in just about whatever you want. I'll talk about some of the limitations that the IRS has given us, which is not extensive. So pretty much the sky's the limit. So we're going to talk more about the self-directed side. The conventional side, that's your stocks, bonds, mutual funds. Think Vanguard, Fidelity, ETFs, that sort of thing. Nothing wrong with that, by the way. It's just one type of asset. It's in the stock market. ETFs, you could argue, are a little bit different than that, but primarily you're in the stock market over there. Whereas the self-directed side versus conventional, let's say you want to do crypto, you can do crypto in an ETF on the conventional side at Vanguard, but in the self-directed side, you can actually buy Bitcoin itself. And so that's a primary difference there. So it does offer true diversification. You can use your IRA or 401k to invest in real estate, both commercial and residential, tax deeds, tax liens, trust deeds. You can invest, I mentioned already, in crypto. You can buy precious metals. You can invest. You can be a private lender. Many of our clients use this for private lending. I would say it's probably a toss-up, maybe 50-50 between actually holding the hard asset of real estate in your retirement account versus doing private lending. Those are primarily the two ways that people invest. Although syndication is a really big one as well. People want to invest in apartments and public storage units and that sort of thing using their IRA money. And so syndications are part of this in a lot of ways. But I'll keep going down this. Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. And so the last one was probably COVID, although for us as realtors, it was short-lived, right? Because 2021 and 2022 were amazing years if you were in the real estate industry for most of us. And interest rates were super low. It was just wild. But before that, it was 2008, 2009. Now, people who had self-directed retirement accounts, or maybe even not, but were primarily invested in something backed by a hard asset like possibly gold or but primarily real estate, were very kind of isolated from those or protected from those dips that happened, right? And sometimes dips are okay, right? They give opportunities for people to buy stuff at really good prices, right? If you had money in 2009 and 10, you could get some real estate for some smoking prices, and it's gone up and some obviously since then. So wish I had enough money. I would have bought 20 in 2010 if I knew what I know now. But anyway, I digress. Think about it like this. I can put my money in the S&P 500 and I can look back historically at what has happened and know that I'm probably going to get, like, let's call it 10% return for ease of conversation. That's great. There's going to be ups and downs and everything in between. Now, in real estate, you can do the same thing. You can see, okay, historically, here's what, certain zip code in certain city has done. And so I kind of know what the appreciation might look like moving forward, similar to the stock market. But where the primary difference is, not only two reasons. One, if you hold a rental property or you're a private lender, somebody, two parties are signing on the dotted line what your return is going to be. Okay. So it is a guaranteed, pretty much, things can happen, but it's pretty much a guaranteed return on your investment. I'm not talking about appreciation. We don't know what that looks like. I'm talking about the rental income coming in every month. I'm talking about the 2 points paid up front plus a 14% interest on a 6 month term for fix and flippers that you're loaning money to over and over again. I'm talking about syndications, these returns. You have a really good idea because it's like written down on paper what it's going to be. Okay, that does not exist in the stock market. The other reason is I mentioned there were two, and this has to do with actually buying real estate in your IRA, is that you can get financing. Um, I know you can buy stocks on what's it called, on margin, and that's kind of like financing, but I don't know. I think that's kind of gambling to a certain extent. So, but with real estate, you can get financing and you can buy twice the amount of property. Now, it's gonna, and I'll talk about this. I have a slide later on non-recourse financing, which is what's required inside the retirement account. But you can put 30 to 50% down and buy double or more the amount of real estate, right? Nobody will give you money to buy S&P 500. And even if they do, it's like you don't know what the return is going to look like, especially from a monthly mortgage perspective, or monthly rent rather perspective. So hopefully that makes sense. But that's why I get excited about this. I'm like, man, you can truly take control of what you invest in versus just putting your money in Vanguard and looking at history. And don't misunderstand me. The stock market has been on a tear. I don't know. That's not the right way to say it. The stock market has been ripping this year. Like, it is amazing what 2024 has happened in the stock market. But that's okay. Like, we should have some money there, and we should possibly have some money here. Again, not tax advice or financial advice. I'm just saying it's okay to be diversified. First, a quick diagram here. Brad and Jennifer out of Phoenix, Arizona, real estate agents, have done very well. Brad came to us many years ago, 7, 8 years ago, and as a real estate agent, he qualified for a solo 401k. His goal was diversification. So we helped him unlock or roll into his new solo 401k that was sponsored by or adopted by his real estate agent business. Him and his wife are in business together, so they both participate in this plan. And he rolled over his previous employer W-2 401ks and some other IRAs into the solo 401k and started buying real estate. But he didn't just do this in his traditional pre-tax 401k. He did it in his Roth 401k. So he has millions of dollars in real estate and lots of cash in his 401k, although he doesn't have a lot of cash because it's deployed into investments, but he can realize that anytime he wants in his Roth by selling property or taking a distribution, because there's no taxes. Like, it's literally a tax-free ATM. So I'm going to talk here in a few minutes about doing a Roth conversion and how you can really supercharge your tax-free income at retirement. So I mentioned two options: self-directed IRA versus solo 401k. The solo 401k has a self-employment requirement attached to it. I mentioned that at the beginning. As a real estate agent, we're self-employed. We get a 1099. It doesn't matter if you're a sole proprietor, if you are an LLC, single member LLC, if you're filing as an S Corp, C Corp, partnership, all of those qualify to sponsor a solo 401k. The one caveat is you can't have full-time W-2 employees outside of yourself and a spouse. Okay, so Bible says you and your spouse are one, so you are one, right? So you can both participate in the solo 401k. The benefit is, though, you get to double the benefits, right? And I'll talk about the annual contribution amounts and that sort of thing here in a few minutes. Whereas on the self-directed IRA side, which is probably what's going to fit most of your clients, these are the W-2 income earners, no self-employment activity at all. They don't even mow lawns on the weekends. They don't sell stuff on eBay. They have like no self-employment income that they're reporting or self-employment activity. And by the way, that's an important distinction. It's the self-employment activity that qualifies you to adopt a solo 401k plan, not the self-employment income. The self-employment income will dictate the contributions that you can put in to the 401k from the adopting business, but they don't qualify you or unqualify you. The IRS fully expects people to have up years and down years when it comes to business, especially small business like solopreneur businesses. So it's okay. There's no contribution minimums per se. There really isn't actually. And so what it would allow you to do, the reason I bring this up is because you may be sitting on here, or you may know somebody you know that's self-employed, but they just started their self-employment and they're not really making a lot of money, but they heard about being able to invest in real estate or private lending or crypto or whatever inside the retirement account, and they're looking at their options, and they're looking at the self-directed IRA, and they're looking at the solo 401k, and they don't think they qualify for the solo 401k because they're not making any money. That's not true. And I'm going to talk in a few minutes why the solo is more a better plan than the self-directed IRA for a lot of reasons, though both are very similar. So we do a lot of self-directed IRAs. Okay, we do both. The self-directed IRA, the reason there's the diverse crowd there is because it's really for anybody. Anybody who has money to roll into a self-directed retirement account could consider and ultimately put in place a self-directed IRA. All right, so how does the checkbook IRA work? This is like the only slide I have on checkbook IRA, and the rest is solo 401k. So bear with me. So here's how it works. First, you say, hey, I want to do this. Okay. Our process, by the way, we jump on a call, free consultation, complimentary, talk through the situation. Even if you don't end up becoming a client, you're going to walk away with value from that call. I guarantee it. But let's say it all works out and you're like, yeah, I want to roll this $100,000 IRA into a self-directed IRA. And the reason we call it a checkbook IRA is because there's two types of retirement accounts. There's a full custodial account, and then there's a checkbook control account. And the reason we like the checkbook control is because we actually bypass the custodian in the IRA using a special purpose LLC. And so you are the manager of the LLC. And what that means is you don't, with the full custodial account, you actually have to go through the custodian for all investments, all transactions. So think about owning just one rental property. How many transactions are there, right? There's monthly rental income, there's paying the plumber, there's possibly paying the property manager for something outside of what they take on their monthly fee out of the gross monthly rent. But there's a lot of transactions throughout the year. If you have to go through the custodian for those, first off, depending on the fee schedule, there could be a transaction fee every time you do that. And secondly, it's just a pain. You have to go on, usually on their portal online, and submit a request. Think about buying real estate. The custodian buys the real estate for benefit of your retirement account. So the custodian signs all the purchase agreements, all the disclosures, everything involved. They have to they don't approve everything from the perspective of being a second set of eyes. That's not what it is. Some people think having a custodian involved is like another vetting process to make sure an investment is good or not. That's not the case at all. They will do whatever you tell them to do. And actually, syndication operators typically can't stand the full custodial IRAs because sometimes, not sometimes, all the time, there's a deadline. And going through the custodian can add that extra red tape that causes delays to get the money into the account to add to the pool of investors for that offering. So anyway, that's the custodial account. That's why we do the checkbook control. So once you say I'm ready to go, we'll open up the new account with the IRS approved custodian. This is not Vanguard, Fidelity, T. Rowe Price, Schwab, Edward Jones. This is a custodian that's IRS approved that allows for non-Wall Street assets to be invested in. Okay. So then the qualified transfer is set up. This can come from an IRA, Roth, traditional, 401k, 403b, whatever you'd like. Typically, if it's a 401k, it's got to be from a former employer, although not always. About 2/3 of employer-sponsored plans, once you're over 50, will allow you to do what's called an in-service rollover. And what that means is you stay in service, you stay employed there, but you can roll over some of the funds into the retirement account out of the existing W-2 sponsored plan into a new qualified retirement account, whether that be solo 401k or checkbook IRA, that actually applies. And so you do the transfer, and most people, probably about 99.9%, actually probably 100% of the people that set up checkbook IRAs are doing some kind of transfer. The annual contribution limit for 2024 is 7,000 or 8,000 if you're over 50. and or under 50. And so usually it makes sense to have existing funds to roll over because starting from scratch at $7,000 or $8,000, it's kind of hard to invest in non-Wall Street assets with. So most people are doing a rollover. So I mentioned the special purpose LLC. This is designed to be owned by an IRA. The single member is the IRA. You are the manager. Okay. You're a non-owner manager of the LLC, right? You're still the beneficiary of the IRA, but this is the LLC. This is how you have checkbook control. So with that manager level access, you can open the bank account. Okay. So the rollover happens, it goes to the custodian, and then it moves into the LLC, which is another way of saying it moves into the checking account in the name of the LLC. And this is quite literally a regular checking account. So you have this money in this checking account that's in your IRA. Well, it's in the LLC owned by the IRA. And then when you find that rental property or whatever it is you want to invest in, you do a wire transfer. You can do online bill pay for stuff, ACH transfers, deposits, and you can write checks. You quite literally have a checkbook. So that's how you get the money from the IRA checking account, LLC checking account rather, into an actual investment. So all income going into and out of all income generated from investments must go into, and then all expenses related to investments must go out of that checking account. So think about the checking account as the home for the funds. Okay. With the exception of the custodian and the LLC, this is literally identical to the solo 401k. Well, with the exception that you need a plan sponsor. And that means, as I said, you have to be self-employed. You have to have that legitimate self-employment activity. Okay. So once you have that, you can open the plan. The sponsor, which is the business, can adopt the plan. The trust is created. So instead of an LLC, we use a trust structure. You are the trustee of that trust, which holds the assets of the plan, which allows you as the trustee to open a bank account or any other brokerage account or financial institution account in the name of the solo 401k. Once that's all done, you can start to self-direct. Okay. By the way, just as a side note, the setup for the checkbook IRA is about 3 to 4 weeks, depending on how quick you respond as the client to things that we ask for. And the setup for the solo 401k, depending on how quickly you respond to what we ask for, is about 4 days. So they're vastly different from that perspective. Let's see, I'm not going to talk about that. Okay, so this is regarding the solo 401k. You can actually contribute up to $76,500 per year per participant if you're over 50. This is for 2024, 69,000 if you're under 50. Proverbs 21:20 says, the wise man saves for the future, but the foolish man spends whatever he gets. So you want to save, obviously, right? I wish I could go back and save more in my life, but the reason you have such high contribution limits is because being self-employed, you wear two hats. You're the employee and you're the employer. And I think as real estate agents, we can probably relate to this better than almost any other industry because we work for a madman or a madwoman most of the time, and that's ourself. But as the employee, you can do what's called elective deferral or employee contributions. This is the same as a W-2 401k, but you also have the employer contributions, also known as profit sharing, which is roughly 20% of the profit of the company on top of the elective deferral. Okay, so it's actually, I think I have another slide. Yeah, here we go. So the elective deferral, this is 2024 numbers, is up to $23,000 per year, which can be up to 100% of your self-employment earnings, right? So if you make about 23, a little bit more actually, because you have to account for some FICA and Medicare tax and that sort of thing, then you could put in 23,000. Okay. Now on the profit sharing side, it's a percentage of the profit or the income if you're W-2 for yourself, paying yourself a W-2. It's a percentage, right? So it's not dollar for dollar. Like up to 23 is almost 100% of what you make, whereas the rest is a percentage. So that's how you get from 23 up to 69 or 76. Okay. Now, if you're over 50, the elective deferral has the $7,500 catch up. Okay. These can be pre-tax or after-tax Roth contributions. It's totally up to you. Both of them can be, not just the elective deferral. And here's the updates for 2025. So let's see, the 401k employee contributions going up $500. And then there is an interesting catch-up contribution for those aged 60 to 63. Instead of $7,500 catch-up, you now have an $11,500 catch-up. And then you can see the HSA change there on the bottom. So I mentioned using leverage. The property non-recourse lending means that you can't make a personal guarantee. Okay, you are a disqualified party to the retirement account. I'll talk more about what that means in a moment, which basically means you cannot make a personal guarantee when it comes to leverage. So the property must be the only security. Okay, interest rates are a little higher, but it's a riskier loan, which also requires more down, 30 to 50% down. And the property needs to cash flow a few $100 a month. And then you do have to have some reserves. We have a list of lenders on our website there at sensefinancial.com/non-recourse-lenders. And you can see they all have different terms and conditions and such requirements. So you can go through them. There's probably 10 or 12 on there. And this will trigger a UDFI tax for the IRA. I'll talk more about that here in a moment. What are the disallowed investments? Well, two things: life insurance and collectibles. So collectibles, baseball cards, stamps, cars, art, NFTs, that sort of thing. Those are disallowed, okay, in the IRA. Actually, in the 401k, you can invest in some forms of life insurance, but in the IRA, it's not allowed at all. Okay. The other thing is disqualified persons. So think of the lineal descents: you, your spouse, your children, their spouses, your parents, your grandparents are all disqualified people. That means they can't provide services for anything for the 401k or anything or IRA or anything that it owns. You also can't benefit from it, so you can't get paid. You can't if my 401k buys a rental property as a licensed agent, I can't represent my 401k because I would be providing services. Even if I don't take a paycheck, I still can't do that. If I took commission from it and I provided services, I'd be violating two different rules there. And this is a really big deal, by the way, in the IRA because it can disqualify your entire IRA. In the 401k, it's not as bad, but you still want to avoid doing it. And you also, like, another example is you can't personally benefit, so you can't go stay at a rental property that the retirement account owns. From a work perspective or providing services, you can do the white collar work. You can't do the blue collar work. That's the easiest way to say it. So you can hire the person that swings the hammer, but you can't swing the hammer yourself. You can pick out the tile, but you can't install the tile. You can pick out the color paint, but you can't paint. Okay, that's the easiest way to say it. You can even walk through the house to make sure the rehab is going well, and you can guide and direct, but you can't do the work yourself. All right, so that's how that works. Why is that not changing? Hold on. Okay. So this is a one screen shot of the benefits. The self-directed IRA, that's that full custodial IRA we were talking about. And then the IRA LLC, aka checkbook IRA versus solo 401k, is what we're primarily going to focus on. And just to point you to a couple of different things here, I don't think I said this, but with the solo 401k, we actually eliminate the custodian. There is no custodian. And the reason the custodian is around with the IRA, besides the fact that the IRS requires it, so that's reason number one. So the custodian will still come into play during rollovers, Roth conversions, which I still need to talk about a little bit more, and distributions, and then the annual valuation. With the solo 401k, by the way, both of these are really easy to maintain from you as the fiduciary of the plan. Basically, you provide the value to the custodian for the IRA every year. It's a 5498 form. And then with the solo 401k, there's a 5500 EZ form. Both of these are pretty much identical, where you're literally telling the IRS, here's the total value of the plan. It's not a taxable thing. It's just, they just want to keep track of what we have, I guess. And but the solo 401k, the 5500 EZ, isn't required until you get to at least $250,000 of total plan assets. Of course, you don't have any LLC fees with the solo 401k where you do with the IRA. And then the UBIT. So this is income derived from the portion of the income on the rental property that is because of the mortgage. So if it's 50% financed, then 50% of the income for the year on that property is going to be subject to this tax. Now, before it's calculated, you subtract the first 1,000 and you deduct expenses, again, 50%. And then you also can use depreciation to help reduce that as well. And so it can be a deterrent, but I don't think it should be a deterrent. It does scale up to 37%, but not until it gets to about 12,500 of income after all that stuff I mentioned, the depreciation, subtracting the first 1,000, and also deducting the expenses. If you're doing cost segregations or you're part of a syndication that's doing cost segregations, this tax is almost non-existent, especially in the first few years of a multifamily type syndication because there's so many losses that are reported. But with the solo 401k, this tax doesn't exist. Okay, so another reason the solo 401k is more beneficial, of course, if you're going to buy real estate and use financing, of course, the contribution limits are vastly different for the IRA versus 401k. And then the IRA is either a Roth IRA or it's a traditional IRA. If you want to self-direct both, you have to have two self-directed IRAs. The solo 401k has both Roth and traditional pre-tax built in. And I'm going to spend a minute talking about Roth conversion. Either one of these, you can do a Roth conversion. So you can convert cash, and I'm almost done, I promise you. You can convert cash, or you can convert. Well, there's three ways to get money from into the account as Roth. Okay, you can make straight Roth conversions. You can do a conversion from traditional pre-tax money to Roth money. Both of those are taxed at the full dollar value, right? If I convert $100,000 or I contribute $10,000, that amount of income is being added to my taxable income for the year, okay? Because it's after tax money. No taxes on the way out at distribution, but you're paying taxes today. And then you can do a Roth conversion of assets. Okay, so this is super cool. It's a way to hack your way to more Roth money for less taxes. So real life example. Client of ours has a $50,000 second mortgage or second trust deed here in California on a property. Okay. It's an owner occupied property. Borrower goes in default. Notice of default is filed. And this client goes to a third party valuation company, which we have on our website as a recommended vendor, and says, hey, I want to do a Roth conversion. IRS requires this third party valuation, kind of like an appraisal from an approved company, not just a regular appraisal like you would do for purchase money loan or refinance, but for this purpose. And they value it. They always value it at less than the principal investment, by the way. In this case, it was really aggressive because of the default from the borrower. So this $50,000 note, which he's converting the entire $50,000 note to Roth. Okay. So that means well, let me say this. The value came in at $21,000. So he's doing this, the taxable amount, or excuse me, the income that's being added to his taxable income for the year is $21,000, not 50, but he's converting the whole 50. So all the payoffs, it's in default, of course. So there's no payoffs, there's no money coming in, but they could reperform again. Who knows? But he's going through the foreclosure process. So if he actually forecloses on this from second position, he can make the first current and then get this $330-ish thousand property all in his Roth IRA, all tax-free income. He's 50. So in 9.5 years, he's going to be able to take distributions from his Roth with no penalties, all tax-free. So all this, I mean, it's just a great way to hack your money. Now, if it wasn't in default, it probably would have been not as aggressive. It probably would have been like a $40,000 valuation instead of 50. So it's still a cool way to kind of hack your way to more money in your Roth. Okay, so that's how you convert an asset to Roth instead of traditional. You can do this with a syndication investment, anything actually, real estate, a loan like a note like I was talking about. It doesn't matter. Okay. The other thing I didn't mention was the personal loan. So the solo 401k has a participant loan option of up to $50,000 or 50% of the value, whichever is less. And so IRA doesn't have that. By the way, I mentioned this earlier, but you and your spouse can both participate in the same solo 401k plan, but you can also have separate if you have two separate businesses you want to use as the adopting business. But either way, the numbers are the same. So the max contribution doubles, the participant loan doubles, right? Everything basically doubles. So it's super cool. It's a super cool way if you're making enough money to take advantage of these high contribution limits to have both spouses participate. And then, of course, the 401k has the self-employment requirement, whereas the IRA doesn't. And if you do want to talk, I'm happy to. No pressure at all. Totally complimentary. You can jump on my calendar, sensefinancial.com/free consultation, and we can talk. And then I will say this, we do have a super cool ebook called the IRA Makeover. It does talk about the 401k and the IRA, but it's at sensefinancial.com/IRA Makeover if you want to grab that. Again, totally free. And then our contact info is there. But I'll stop talking for a moment because I feel like I
There,
just went on a whirlwind, and I'm happy to answer any questions if there is any.
there is a question there from Anita. She was asking if you can have a solo 401k as a real estate agent with a full-time corporate job. So looks like they got the corporate job, but they do the real estate on the side for now.
Excellent question. And by the way, good job if that's you. Good job not cold turkey in your job like I did back in 2014 because real estate is challenging and I think it's important to have enough reserves and money. Anyway, that's a whole nother conversation. The answer is yes. Now, where it comes into play is on the contributions. You cannot double dip on the elective deferral, the employee contribution. So remember, if you're under 50 for 2024, that's 23,000 going up to 23,500 for 2025. And then if you're over 50, that's 30,500. So if you're maxing that out at your W-2, you only have the profit sharing capability for contributions in the solo 401k. You can still do them. Again, it's going to be 20% of the net profit or 25% of the payroll if you're filing as an S corp, and then you wouldn't be able to do the elective deferral. But if you're only putting in 10,000 and you're under 50 at your W-2 job, you can put in another 13 at the solo 401k. Now, again, this could be up to just about 100% of your pay in your self-employment. So if you get a commission check of $15,000 in my example, you could put in 13 of that in the solo 401k and not have that added to your taxable income for the year as a pre-tax contribution. Okay, so that's the only real way it affects it. Good question. Appreciate that.
Very good. Any other questions?
Is there another chat? I just saw something pop.
Anita just said thank you.
Oh, cool. Yeah, my pleasure, Anita.
And we'll get the information for Brett out there so you guys can connect. I mean, it's a great opportunity. As I mentioned, don't just want to be talking about one particular subject, but just hopefully adding value to you joining these calls on a weekly basis. Just
Let me say
following
one
up.
more thing. So sorry.
Yeah, go ahead.
We have a lot of clients investing in international real estate inside of their IRA or 401k. So remember when I said the only limits are life insurance and collectibles? Those are the only limits. So if you have international clients like buying in Mexico, for example, they can do this inside their IRA or 401k. Now, the caveat is they can't go stay there. So if they're looking for something that they can personally benefit from, this is not the vehicle for them. But if they're looking for something for investment, let's say they're 55 years old and at 59 and a half, they buy this property, which is 4.5 years later, they can actually distribute the property to themselves. Because when you do distributions, you can distribute assets to yourself, just like Roth conversions, or you can distribute cash to yourself. So if they want to, when they retire, they could distribute the property to themselves, and now they can use it personally for, whatever. So,
Paul, you bring up a good point. I mean, that would have been a good question is, can this be done with properties in Mexico? You've answered that properly. So if you guys, ladies, if you have clients that have money from their 401k and they want to move it over to a self-directed or 401 solo 401k, that's an opportunity. You can have those conversations with Brett that can give a little bit more guidance on that.
Absolutely.
Yeah.
Appreciate the opportunity, Rogelio. Is there another one?
No, let me see.
All
Anybody?
right. Guys are quiet.
I know they are kind of quiet. Probably during the lunch hour. All right, I'm gonna stop the recording here and